Welcome to Talk Tickers, your shortcut for getting up to speed on the latest earnings calls.
That's right.
Today, we're doing a deep dive into Insteel Industries' third quarter 2025 earnings call. We've gone through the transcript, the presentation, really trying to pull out the critical insights for you without all the usual jargon.
Yeah, our goal here is pretty simple. Break down what happened, explain why it matters for the company, and maybe what signals it's sending for the wider market. We're cutting straight to the core numbers and what management had to say.
Okay, let's kick things off then. The headline numbers for Insteel's Q3 fiscal 25, and it looked like a strong quarter. Really strong.
Oh, absolutely. A very strong quarter. Net earnings surged to $15.2 million. That's 78 cents per share.
Okay.
Now compare that to last year, $6.6 million, or just 34 cents per share.
Wow, big difference.
Huge difference. Significant jump. And even if you exclude some restructuring charges, their adjusted earnings were 81 cents per share. Solid numbers.
So what was behind that? I mean, what really drove that kind of performance?
It looks like it was largely a combination of two things. First, higher shipment volumes.
Right.
And second, a really substantial recovery in the spreads, the gap between their selling prices and their raw material costs. Average selling prices actually climbed 11.7% compared to last year.
11.7%.
Yeah. And even 8.2% just from Q2. So that reflects price increases they've been pushing through all year, including more this quarter.
Got it. So they had pricing power. And how did that flow through? Top line, margins?
Well, shipments were up 10.5% year over year and also up 3.5% sequentially from Q2. And that growth came from, their recent acquisitions helped, but also just improving demand in their core construction markets.
Okay.
And the margin story is pretty impressive. Gross profit jumped by $15.4 million from a year ago, hitting $30.8 million.
$15 million more in gross profit.
Exactly. And that pushed their gross margin up by 650 basis points.
Whoa.
Yeah, it's a 6.5 percentage point increase up to 17.1%, mostly because those selling price increases really outpaced the rise in raw material costs. Plus, they got a bit of a tailwind from FIFO accounting, selling older, lower-cost inventory first.
Okay, FIFA helping out there. What about on the expense side? SG&A, taxes, how did that look? Did the gains hold?
SG&A did go up. It rose to $10.6 million, which is 5.9% of net sales. That's compared to $7.9 million or 5.4% last year.
Any particular reason for the jump?
Yeah, a good chunk of it, about $2.5 million, was higher incentive compensation. Basically, bonuses tied to their improved performance return on capital.
Makes sense.
And there was about $300,000 more in amortization from the recent acquisitions, too. But the effective tax rate actually dipped a bit, down to 23.3% from 24.7% a year ago. So slightly better there.
All right. And the cash situation. How's the balance sheet looking after all this?
Very healthy. Operating activities generated $28.2 million in cash.
Strong cash flow.
Very strong.
Yeah.
Driven by those higher earnings, but also, interestingly, a reduction in net working capital. That actually came from a big jump in accounts payable and accrued expenses,
Right.
Reflecting buying more raw materials at those higher costs.
Okay.
But the bottom line, for cash, they ended the quarter with $53.7 million of cash sitting there.
$53 million.
And zero debt.
Zero debt. Wow.
Yep. Plus, they haven't touched their $100 million revolving credit facility. So lots of flexibility.
And capital spending.
CapEx.
Pretty light this quarter. $1.6 million. Year to date, it's $6.5 million. We'll get to why that's a bit lower later.
Okay. So strong results, good cash position. Let's unpack this a bit more, dig into the commentary, because it's fascinating how they achieve this despite some, pretty obvious headwinds out there.
It really is. Management pointed out that the pickup in business they've seen over the last few quarters, that continued right through Q3. And this is even while the broader construction indicator, the macro data, still looking kind of mediocre.
Right. That's the disconnect. Exactly. But they were quite firm, saying the demand recovery they're seeing is, quote, nevertheless real. Based on talking to customers, seasonal trends, they seem confident for the rest of the year.
Okay, now here's where it gets really interesting for me. Raw materials. They specifically mentioned the U.S. wire rod market is still incredibly tight.
Yeah, that's a huge factor. And it raises the question, right? How did they actually handle that? You've got published steel wire rod prices up about $190 a ton since January.
$190 a ton. Ouch.
Yeah. And limited supply on top of that. So what they did was supplement their domestic buying with a lot of offshore volume. They said about 25% to 30% of their steel needs are now being met with imports.
Okay, so leaning on imports.
Had to. It was critical just to get enough material to support production. But even then, they admitted they couldn't meet all the demand out there. They ran into production issues, lead time problems, all because of that wire rod scarcity. Even lost some shipments because of it.
So the tightness is definitely impacting operations, even with the imports.
For sure. It underscores how severe that supply squeeze really is.
And then you layer on the tariffs. That's just another layer of complexity, especially with steel. How's that playing out?
Well, directly, tariffs only hit about 10% of Insteel's revenue from imported finished goods. But the indirect effects and the uncertainty, that's the bigger story.
Okay.
Specifically, the Section 232 tariff on things like PC strand, that's a key construction steel product, that tariff was doubled to 50% back in June.
50% tariff.
Right. But here's the kicker, the real confusion. The executive orders seem to imply the tariff only applied to the steel value within the imported product, not the whole product's value. So some importers started reporting just the value of the raw wire rod, or even just steel scrap, to calculate the tariff, trying to minimize the hit.
Exploiting the ambiguity.
Exactly. And still thinks that's wrong, that the intent was always the full value. They're pushing the Department of Commerce hard on this, arguing these interpretations undermine the whole point of the tariff.
Is there any resolution in sight?
Not yet. But the uncertainty itself is already making importers really cautious. Nobody wants to get hit with a massive retroactive bill if Commerce clarifies it the way Insteel expects.
Okay, so that's the finished goods import side. What about the raw materials they're importing? Or other costs?
Yeah, the tariffs hit them there too. Their spare parts, mostly from Europe. Big administrative headache. Customs wants super detailed info, slows things down, adds costs.
Right.
And crucially, those offshore raw materials, the wire rod they need because domestic supply isn't enough. Tariffs apply there too. And Steel's basically decided they have to import it anyway and just pass those higher costs through to customers. Their bet is that competitors are in the exact same boat. Nobody can really absorb a 50% hit.
Makes sense. Okay, let's shift gears slightly. Strategy. They've made some acquisitions recently. How are those integrating?
They sound pretty happy with them, both the Upper Sandusky, Ohio facility and a smaller one in Texas. Management gave kudos to the teams for handling the integration well, which, isn't always easy.
No, definitely not.
When someone asked about their best acquisition ever, they actually pointed back to one in 2011, the IV acquisition. Said that was more transformative, gave them scale, national footprint, but they still called the recent ones very good. So it seems like they're adding value.
Good to hear. And what about that CapEx number being lower? You mentioned we'd get back to that.
Right. So they lowered the full year forecast from $17 million down to $11 million for this fiscal year.
Okay. Why this cut?
It wasn't project cancellations. It was just that the resources, people's time and attention were really tied up with integrating those new acquisitions.
Bandwidth constraints.
Pretty much. But they stressed, no projects canceled. They fully intend to ramp investment back up in the coming years to lower costs and add products.
Yeah.
We should get a look at their 2026 CapEx plan next quarter.
Got it. So let's connect all this to the bigger picture now, the macro environment. It sounds mixed, uncertain.
That's a good way to put it. Definitely mixed, definitely uncertain for their end markets.
What specific data points did they share that kind of illustrate that? What stood out to you?
Well, some key leading indicators for non-residential construction look a bit shaky near term. The Architectural Billings Index, the ABI.
Right. Always watch that one.
It was at 47.2. Still below 50, which means contraction, though it eased slightly. So fewer architects reporting increased billings.
Not great.
But on the flip side, the Dodge Momentum Index, which tracks projects and planning, that looked better. Up almost 7% month over month, up 20% year over year, especially strong in commercial. So that suggests maybe a pipeline is building further out.
Okay, so maybe near-term weakness, but potential future strength. But you said other indicators were softer.
Yeah, it's a real mixed bag. U.S. cement shipments, for example, only up slightly year over year in the latest data, but still down quite a bit year to date compared to last year. And total construction spending actually dips month over month and was down year over year. Non-residential spending, including highways, a key market for Insteel, that was also down.
So current activity seems a bit sluggish based on that data.
It does. It contrasts with Insteel's own reported strength, which is interesting.
And then the really big macro factors, interest rates, inflation.
Well, the Fed has signaled maybe rate cuts later this year. That could help construction activity.
Could being the operative word.
Exactly. Because inflation is still sticky. Economic data is uneven. Those cuts could easily get delayed or be smaller than hoped. And then there's always the U.S. trade policy, tariffs, especially steel. that just adds another layer of uncertainty for costs and long-term demand. It's complex.
We had a listener ask about backlogs. Given Instill's strong activity, are they building up orders they can't fill?
That's a great question. And yes, management said their backlogs, which are usually pretty minimal, have grown quite a bit, mostly because of those raw material constraints we talked about. They actually said backlogs are now, quote, lengthy enough to concern them about service levels.
So demand is there, maybe even exceeding their current ability to supply smoothly.
Seems that way. They also mentioned that strong demand from data centers and other big projects is helping to offset any slowness in general commercial construction.
Interesting. Another listener question, any timeline on getting clarity on that tariff ambiguity? The whole steel value versus full value thing?
Unfortunately, no clear timeline. They said they're being very vocal with the Department of Commerce, really pushing the issue. But, government moves at its own pace. The key thing is the uncertainty itself is already impacting importer behavior. People are being cautious.
Right, the chilling effect.
Exactly.
And one last listener question, how much does the weak residential housing market hurt them?
They addressed that, said, look, they'd love a housing recovery, sure, but it's not their main driver. Their belief is that the Infrastructure Act, the IIJA money, is finally really starting to flow.
The infrastructure spending kicking in.
Yeah, they think that's driving real demand across different customers and regions, particularly in commercial and infrastructure, enough to support their business, even with housing being weak.
Okay. So, putting this all together, the strong results, the cost pass-throughs, the raw material issues, the tariff mess, the acquisitions, the mixed macro.
It definitely raises an interesting question for investors, doesn't it? Given all this complexity, especially the tariff situation and the tight domestic steel supply, how might you even think about playing this?
All right, here we go. Time for our This Is Not Financial Advices segment. Let's hear a provocative, maybe slightly outrageous, but plausible trade idea based on all this.
Okay, consider this. A pair trade.
A pair trade, long one, short another.
Exactly. Go long Insteel Industries.
Okay, why long Insteel?
Because they've shown they can manage these higher costs, they can pass them through, they've got that fortress balance sheet, zero debt, tons of cash, and they're strategically using imports to manage the raw material squeeze. Plus, that FIFO accounting helps reported profits in this environment.
So betting on their execution and financial strength, what's the outside? Who do you short against them?
You short a smaller, non-integrated steel fabricator, someone who is really heavily reliant on imported PC strands specifically.
Targeting the tariff victim.
Precisely. The bet is that eventually the administration will clarify the Section 232 tariff rules, likely siding with Insteel's view that it applies to the full value of the imported PC strand. If that happens, these smaller players who don't have Insteel's scale or sourcing flexibility could get slammed with suddenly much higher input costs.
Plus, they might not be able to pass on.
Right. It could severely squeeze their margins, maybe even threaten their viability.
Yeah.
So you're betting on that policy clarification, creating a divergence in performance.
Long Insteel, short the vulnerable importer. That's definitely a provocative idea playing on the tariff uncertainty.
High risk, potentially high reward, hinges on that policy outcome.
Okay, so let's wrap this up. To recap Insteel's quarter, really strong performance, driven by pricing and volume.
Yeah, they navigated some serious challenges, raw material tightness, complex tariffs, pretty effectively.
Management seems confident, even with the mixed macro signals. And that strong liquidity, zero debt, gives them a lot of options.
Definitely. They're watching the trends, watching tariffs, but focused on execution. Shipping product, managing costs, integrating acquisitions, and looking for growth.
All right. Well, just a reminder to everyone listening, the information we shared here on Talk Tickers, it's purely for informational purposes.
Absolutely. This is not financial advice. Never invest based solely on what you hear on a podcast.
Always do your own research, consider your own situation, and please talk to a qualified financial professional before making any investment decisions.
We really hope this deep dive into the Insteel Industries call gave you some useful insights, helped connect some dots.
Yeah, hopefully it cut through some of the noise for you. Until next time, stay informed, everyone, and keep a sharp eye on those tickers.